Welcome to the Thomson Reuters Idea of the Week and Alpha Now. I'm John Cozy. The hunt for yield is pushing our list of high yield and low dividend stocks ahead of the S&P 500 by some 180 basis points over the last 2 months. But if you want some yield while looking to reduce taxes on dividends and put a growth bias into your portfolio, then our list of low yield and low payout names in the blue line may help. That growth bias has certainly worked in the early part of 2013 compared to the S&P 500 line in orange. So what's the case for companies with lower dividend yields and lower payout rates? Paying a dividend may imply management's confidence in generating ongoing profits. Keeping dividend payouts low retains earnings to help grow their businesses. And StarMine screening can help identify issues that may turn into potential landmines to be avoided. We looked back at our December list of 151 names that fit our parameters using StarMine screening from the Alpha Now website. The list today shows a 13% forecast growth rate for the next 12 months using StarMine's Smart Estimate. That's 40% higher than the S&P 500's 9% estimate. Chicago Bridge & Iron's on the list. Its energy and global infrastructure focus results in less than 30% of revenues coming from the US and Canada. StarMine's 5-year analyst compound growth rate of 14+% is almost double the S&P figure of 7%. The stock has beaten the S&P 500's 15% return the past 2 years with a 45% total return. Technology company Convergys Group can grow earnings too. The senior management in place since last year is using its ample cash balance to increase its dividend and buy back shares. Plus, StarMine shows a 5-year Smart Estimate forecast for EPS growth at almost 11%. Financials are well represented with 28 names, including reinsurer Renaissance Re Holdings. Although past performance doesn't guarantee future performance, here's a stock that's returned 58% in the last 5 years compared to the S&P 500's 15%. Renaissance Re scores well in all StarMine models among U.S. and North American companies. It lies in the middle of the pack of reinsurance peers for 5-year forecast earnings growth. And one more thing, because these companies have more of a growth bias than the market, one would expect them to benefit during uptrends and become susceptible to heavier than average profit taking in times of caution. Thanks for watching. I'm John Cozy.